What's going on, ladies and gentlemen? Welcome back to another video. Today we're going to be walking through a bunch of different technical analysis on the current stock market and the current condition in which we are at. There's a ton of questions out there. There's a lot of fear of whether or not the market's going to crash right now. There's a lot of people really guessing and questioning whether or not right now we are at the bottom of the stock market correction. And the answer is no, we're not. There's a lot further we're going to go down. Okay. Most people don't believe it, but again, most people never want to believe that the market's going to crash and it's going to go down, and quite frankly, they're going to get crushed. But let's walk you through some things. Let's make this pretty evident for most of you investors to understand what we're currently looking at. Right now on the screen, we're looking at a 20-year weekly chart of the S&P 500 ETF. So the SPDR ETF, SPY. What we're looking at is a chart of the past 20 years. The cool thing about this 20-year chart is what it does for us is it shows us all the past stock market crashes. Right here we have the dot-com bubble. Right here is the 2008 crash. And right now, soon to probably be the 2018, 2019, 2021 stock market crash right here, okay? Which we've already really started. So we might as well call this the 2018, 2019 stock market crash, okay? So the cool thing about this chart is we get to look back at a ton of history and see what it shows us, okay? So back in the dot-com age, 1999, 2000, the dot-com bubble, we had the dot-com bubble where we ended up crashing or breaking down from, 2000 all the way to 2002. So that bear market itself lasted 1, 2, 3, well, arguably really 2 years. It was really about a 2-year, arguably a 2.5-year bear market, okay? 2008, 2007 was really just a 1.5 to 1 year stock market crash, okay? Right now, we're currently on, probably a couple months right now where we've been really crashing, okay? But the thing is, okay, the most recent stock market crash we have to compare to what we're currently looking at in 2018 would be the 2008 stock market crash. So what you guys have to understand about corrections, or not really corrections, but recessions and bear markets, is that they happen on average really like every 4 to 6 years, right? 4 to 5 years, 5, 6 years, right in that time frame is typically how long we will see a bull market and then end up going into a bear market, right? So it's usually about, every 4 years or 5 years of a bull market will then head into a recession where the economy goes through a downturn, kind of a slow period, okay? Now, 2008 was just terrible, okay? We had the whole housing market come down. We had the housing market crash, and that's really why 2008 was so bad, okay? Now, there's a lot of things that are similar to 2008 in this current day and age, but they're just not the same, right? So we don't have necessarily a huge housing market issue that we had in 2008, okay? We don't necessarily have the dot-com bubble, what we had, in 1999, 2000. Right now in 2018, what we really have is a company that is, an economy that is built off of tons of debt. Okay, we have an economy that has been artificially inflated. Some of you guys may not know what I'm talking about. Some of you guys might know what I'm talking about. Okay, so what we have to understand is the current situation will always be different than the previous. Okay, 2008 is not going to be a 2018. Okay, 2018 is not going to be a 2008. Whatever reason the market's coming down for right now are not the same reasons in 2008, most likely. Okay, so we're going to look at a few things of technical analysis here. All right. So for one, okay, let's look at this trend line here. If we were to do a long-term trend line from back in 2008 on the low and we go all the way up to where we're currently at and follow this trend, that's what it looks like. Okay. We are basically right now just defending this trend line. Okay. You can see right now we are defending that trend. Okay. So going from 2008, this dip here in 2010, this dip here in 2016, all the way to where we're currently at. We're just now kind of tapping that trend line and starting to bounce. Like right now in terms of trend, right now the upward trend line support has been touched. And what I'm talking about is a 10-year trend line from 2008 to 2018. That trend line has been touched last week and we started bouncing, okay? A lot of people are saying, is this the bottom? Is this where we go higher? And honestly, chances are, no, we're probably coming down much lower. We are most likely going to be breaking down further. So as of right now, we have not yet broken that 10-year trend line, okay? We did, in fact, though, break the 3-year trend, which would be right here. Okay, you can see we were holding that trend. Ready? Bounce, 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 break. Now we're down to the 10-year trend line, all right? So we did break a 3-year trend line. We're down to a 10-year trend line now, which is the long-term support. If this long-term trend line support breaks, it's not good. In terms of technical analysis, that means there is no next trend line that it can fall on unless we probably go back way, way further, okay? Next, if you look at this chart, there is no support anywhere. This is not support. There is no structured support system going across, okay? The only actual support system we have in terms of technical trading is going to be down here in this area right here. That is the next support system. So based on the current situation and based on technical analysis and how technical traders would look at this, they would say there is no support until we at least get down to about 215, ranging to $180, at least on this SPDR ETF, which would be the same thing for the actual S&P 500. It would just be down, to 1800, okay? So we have much further we can go until we actually even touch a structured support system. The only thing we're doing right now is we have bounced off our 20-year 200 moving average. We started bouncing off our long-term trend line, but there's actually no structural support system in sight, which means technical traders who would be bullish on this probably aren't going to be bullish until it gets down into the 215 or the 1800 level, okay? So we got a lot further we can go until we even hit structured support, okay? Now, if we do some more technical analysis, which I've done in past videos before, and many of you guys have probably seen this already, but if we were to look at a Fibonacci retracement, okay? So if we were to go from the low in '08 and go through this mega boom that we had in the stock market and go all the way to the high here, what it would tell us is that the stock market is most likely coming down all the way to here or to the high of '07, which is right around this green line. I know it's hard to believe when you look at this chart and go, there's no way that the market's going to come down that much more. But in reality, from a technical standpoint, the Fibonacci retracement tells us that this is actually a respectable level that the market should come down to. If it were to come down to here or down here, then that would be detrimental. But going all the way to at least this yellow line, this blue line, or this green line is actually a respectable pullback. Know what's funny is before I even put this Fibonacci retracement on here, you can actually, we'll go back and do this. Ready? Watch this. This is the funny part. Remember how I said the structured support system is really right here? Okay. What happens when we put these Fibonacci's on? You will see that those Fibonacci retracements line up with the only structured support system in sight. From '08 up to the top of 2018, our structured support system lines up perfect, right? You see the yellow line? The yellow line's within that yellow box I drew. The blue line is right on the bottom of that yellow box I drew. The green line's a little bit further, but it just goes to show that the structured support system we have in sight just so happens to be the respectable pullback area in technical analysis from a Fibonacci standpoint. Okay, so months ago, basically the whole year of 2018, I've been predicting a stock market crash and a correction or a recession that will most likely bring us down into the 1800, 2000 level on the S&P 500. If it really gets ugly, maybe down to the highs of 2007. Now, again, from a technical standpoint, we have a lot further to go. Now, the thing about technicals is technicals don't mean anything when it comes to fundamentals. Fundamentals will trump a technical analysis any day, okay? Because technicals are only so good, okay? That's just the chart. At the end of the day, what drives a stock market higher is the fundamentals of the overall economy. Right now, what you're going to hear is the economy is strong. Everything looks good. Unemployment is low. All the things that you would typically hear of a booming economy. But when you look at the chart tells us the economy is not doing well, okay? And that's one thing you always have to remember is the charts don't lie, okay? Charts don't lie. So whether or not people are saying our economy is good, the stock market's saying otherwise. The stock market is clearly telling us that either the stock market's too high, the economy is really not that good, or there's something brewing beneath the surface that we just don't know about yet, okay? So from a fundamental standpoint, everybody's saying the economy is strong and the economy is good, which is hard to believe. I understand that it's good, but we are actually slowing. And it's pretty obvious we're slowing because the Fed, on their reports from back a couple weeks ago on Wednesday when they raised interest rates, the Fed came out with a report and basically told us inflation was going to increase, unemployment was going to increase, that GDP was going to decrease. So basically they told us that our economy is slowing down. Though somehow on CNBC and these mainstream media sites, we're still being told the economy is strong. Okay, so how is an economy strong when it's built off of tons of debt? It can't be. How is an economy strong when it was artificially propped up? What we mean by this is we had quantitative easing. So basically back from '08 when we crashed and we had the bad recession, blah, blah, blah. The government basically stepped in and tried to play God, as they always do. And of course, they are going to screw everything up as they always do. So the government stepped in and did rounds of quantitative easing. What does that look like? It basically looks like the government artificially printing money and putting it back into our economy to help stimulate our economy and get it to go, get it to grow, get it to boom. So this bull run we've seen from '08 to 2010 was a nice bull run, but it was also built off of artificial, fake economic stimulus that is no longer being pumped into the market. Okay? So what do you think would happen to a bodybuilder that's been taking steroids for a long time, right? He's working out, he's getting strong, but he eventually gets to the point where he's kind of just stagnant. He's plateaued. Then he might look to take steroids so he can continue his growth. That is very similar to what the government did back in '08 all the way up into 2018. They did quantitative easing, basically pumped our economy with artificial money. They are no longer pumping our economy with artificial money. So what do you think is going to happen to our economy or our stock market when it's no longer being given its steroids to boom? It's probably going to sell off, okay? What do you think is going to happen when we have an economy that's built off of massive amount of debt? Not good, okay? There are a lot of signals that are telling us bearish, 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 and I wouldn't fight that. Okay. From a technical standpoint, we have much further to go down. From a fundamental standpoint, the government literally told us our economy is going to slow down. Okay. Like 80% of all the stocks in the S&P 500 are in bear territory or bear markets. There is no questioning anymore. There isn't a question. We're in a bear market. Okay. We are going down and we're going to go down much, much further than where we're currently at. So what should you do? Well, what I would do is probably focus your attention on volatility ETFs. I will come at a later time and do another video regarding volatility ETFs and how you can use those to benefit from the markets going down. If you're not someone who doesn't know about options trading, you don't know how to short stocks and things like that, you still can make money when the market's going down. You just have to find yourself in the right playground. And that's usually going to be in the volatility ETFs. So in a later video, I will come back and show you some more information about the volatility ETFs and how that can help you. But right now, I just want to come out and give you a video on my perspective of the market. The government is going to raise interest rates, okay? The government will continue to raise interest rates at least throughout 2019, as we know. Raising interest rates is not going to be good, okay? The reason they're raising interest rates is to help combat inflation. Even though they're going to be raising interest rates throughout 2019, they've already told us they expect inflation to rise. So the main reason you raise interest rates is to keep inflation down. They're going to raise interest rates and it's still not going to keep inflation down. Inflation is actually projected to raise by 1%. Arguably, 1% isn't all that much, but their job is to keep it from skyrocketing. But they still have to raise interest rates. By that, when you raise interest rates, that means people are going to not be able to afford their homes. People will not be able to afford car loans. Your loans and everything that involves interest and debt, that is all going to be harder to pay back at higher rates. So when you think about all the companies, big companies that bring on debt, When the interest rates rise, they're going to have to pay out more money in interest and pay more money, okay? People who buy homes, their interest rates are going to go up. So consumer spending will slow. What happens when consumer spending slows? The economy slows, okay? So these are all early onset signs that we are heading towards a recession, if not an epic market crash, okay? There are plenty of people that you can listen to. For one, I would recommend you guys listening to Peter Schiff. Peter Schiff has a YouTube channel. Peter Schiff is really, really good in my opinion when it comes to fundamentals and, like the economy. He's not a day trader, he's not an options trader. He's more or less someone who is a, long-term gold, silver kind of guy. So Peter Schiff, he's one of the guys that I follow for, things in regards to the stock market. All right. So definitely check out Peter Schiff. He can give you guys some more insight here on the market, but as a whole, technical side, bearish. Fundamental side, to me, bearish. We have all the key indicators that are telling us bearish. The Fed told us the economy is going to slow. The Fed is going to raise interest rates. Everything's selling off. Nothing looks good. Again, I don't think it's the time to buy. I think it's the time to be selling. Okay, we have a lot of waves we can come down. And there is also belief that we're on what's called like a super cycle or a mega cycle, which is supposed to be kind of the third stock market crash. Like this is the last wave where we're supposed to have an epic stock market crash. I'll let you guys search that up, or maybe I'll come on and do a video at a later time talking about that super cycle. But I hope you guys like the video. That's kind of my output on the market. So what I'm doing right now is I'm most likely shorting the stock market with options. I am long silver. I've built a position on silver right now. I have almost 4,000 shares long on SLV, which I've been buying since, a couple months back. So right now, hey, actually, I'll show you guys now that we're on the video. Why not? So here's SLV, and here's an active trader window. So currently up $1,500. I have 3,800 shares of SLV with an average price of $14.35. I started buying silver back when it was, down here at about $13.80. Started sizing in, really started going heavy on this last curl. So right now I am long bias on silver, long bias on gold, short the stock market. All right, so that's my input. I hope that helps you guys. If you guys have any questions, always leave them in the comment section below. I hope the video helps. Do stay tuned for other videos, and always give a thumbs up before you head out the door, as it does help my channel grow. Thank you guys once again, and stay tuned.